Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Market Wrap, where we talk about the biggest moves in the markets this week and what is driving them. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth.
And I'm John Stepek, senior reporter at Bloomberg and author of the Money Distilled newsletter.
Hello, John. Now, John, this is our last chat of the year. Well, it's our last public chat of the year, should we say.
Yes.
Well, it says we're going to talk about the biggest moves in the market this week. Actually, we need to look at the biggest moves in the market this year. Right?
Yes.
Because it's been kind of an interesting year. So much going on, mostly negative, yet global markets are up nearly 20% across the board. I mean, it's absolutely fascinating. I mean, obviously, it's about AI, it's about falling interest rates, it's about maybe a bit more growth than expected. But nonetheless, when you look at everything and you look at how we started the year, this is kind of extraordinary. And then you look at the FTSE in there, the FTSE 100 up around 20%. Yeah. You look at the all share is still up 17% or so. And then you look at our favourite gold. Well done, gold. 63%.
Pat in the back.
And I know, nice pat in the back. We'll get to silver in a minute. And then you've got the gold miners index up over 150%. And then, of course, there is poor Bitcoin.
Yeah, actually, yes. I had forgotten Bitcoin. Of all the risky stuff that went up. That's interesting. Everything
went up except for Bitcoin, which actually went down about 8%. And then there is the Bitcoin Treasuries Index. So if you think of gold and then leveraged gold being gold miners, and then you've got Bitcoin and you think of the equivalent of gold miners being the Treasury Index, these companies that we've talked about before, listed companies that just hold Bitcoin. And inexplicably, until relatively recently, quite a few of them traded at a premium to the Bitcoin which they hold. Completely insane. We'll never understand this stuff, but there it is. The Bitcoin Treasury Index, again, down 6-7% so far this year. So it's been really interesting. You look at Bitcoin now and you think, well, what is it correlated to?
No, you're right. It's because there is nothing else that you can look at. I mean, the one thing that whenever people were saying, well, it's not digital gold, but it is correlated to the NASDAQ. But the NASDAQ's done fine this year. It hasn't done as well as it normally does.
The NASDAQ is up 18.72% so far. We're talking on the 18th of December, by the way. It is still underperforming the FTSE 100, but not quite as badly as I initially suggested.
And are these local currency figures? Because I think, if you translate it into GBP, so what a British person would actually have got, then I'm pretty sure the FTSE's beaten the NASDAQ by even more than that. But I mean, we shouldn't crow too much because it hasn't happened for a while. But I think it's interesting that there's been that move away from the US. So the US exceptionalism story, I think it is fair to say when you look at the markets, did end this year. I mean, whether that will continue next year is another matter. But
no, I mean, and there's no getting away from the fact that absolutely the best place to invest anywhere until relatively recently, until 2 years ago, was definitely anything to do with the US stock market. So, we can be incredibly jolly about what's going on in the UK and Europe at the moment, but this is quite recent. So the question now is whether moving into next year, this rotation continues. This idea that, the returns from the US are not going to be exceptional over the next few years. And you may, on the other hand, get exceptional returns from the things that have performed horribly over the last couple of decades. Maybe, just maybe, we really are getting to the point where value might have its day in the sun. We've seen gold have its day in the sun, of course. Well done, gold. Maybe small caps will finally have their time in the sun. Maybe we will see the FTSE 100 break through 10,000. I mean, sort of outside chance it'll break through 10,000 before the end of the year at this rate. So the question for next year is, does this rotation continue? And my guess is that it does, given the price differences, given the worries around AI, CapEx, etc. But, forecasts say.
I mean, I do wonder if the small caps will come back just because people will have run out of other stuff to buy. Because that does sometimes happen. It can just be a late cycle thing. I mean, the only problem is the small caps always strike me as being more exposed to your domestic economy. And that's where the kind of gloom generally is just now. That, I mean, not just in the UK, I guess, actually, but particularly in the UK, there's that feeling that businesses are constantly being assaulted by the government, and if that doesn't change next year, then eventually something's kind of going to give. At the same time, though, they are cheap.
They are cheap. Yeah. And of course, they're cheap and ignored. There are there's less money in small caps than there used to be across the board in the US and the UK and in Europe. There are fewer fund managers dedicated to it, etc. And as soon as you get to the point where an area is completely ignored, it begins to look quite interesting. And of course, value as well. There are very few fund managers left focusing on value. There's frankly nobody in the UK who would stand up and say, look at me, I'm a value investor. Obviously, we've had quite a few of them on the podcast, but I think we've had all of them on the podcast, actually.
I think we're actually a support network for the UK's value managers.
Practically are. Anyway, speaking of the UK, we should mention this week's rate cut. Bank of England has now cut rates by 25 basis points, 0.25%. We are now down at 3.75%, so under 4%. It would be nice to look at that and say, well, this is all for good reasons, but of course, actually, it's really more to do with bad stuff, isn't it?
Again, the depressing thing about where we're ending the year for the UK is that it's basically a question of, is growth going to tip over to the point where we get a recession next year, which is still, that's an outside chance. It's not a thing that most people expect, but the poor quality of the recent data does make you think, I wonder if that could be a surprise for next year. And on the other hand, inflation is still much more persistent than so the rate now is at 3.75%, but inflation's only down to about 3.2%. So we're still above target. This is by no means what people in the pre-2008 era would have considered to be tight monetary policy. And obviously things change, macro environments change, and this probably is tight given how everyone's feeling. But yeah, it's not an attractive economy, and most of that, I think it would be fair to say, the policy decisions that have been made have resulted in this. And unless we change some of them, which doesn't seem likely under the current government, then I would expect inflation to still be an issue, but also slow growth to still be an issue next year.
Like a mini bout of stagflation.
Yeah, just kind of grinding, slightly depressing, the sort of soldiering through environment.
Okay.
Can you think of a different outcome there?
No, I can't. No, I can't. Not, as we've discussed endlessly, not until there is a change of government or a change of stance.
Yeah.
I think one of the really interesting things to watch for next year has got to be the rollback of the focus on net zero in the UK. Pretty much everybody everywhere else is rolling back. Hasn't really happened in the UK yet. Bits and bobs of muttering about, maybe all this, maybe that, some changes to the North Sea, etc. But generally speaking, we're still on as an extreme net zero path as we were at the beginning of the year and the year before that and the year before that. And that's clearly, well, people would argue, but looking at electricity prices, clearly unsustainable. You can't be an outlier in this area. So I think that will be one of the things to watch in the UK next year. And I think an awful lot of people are watching that. They are waiting to see a shift in energy prices and, of course, electricity supply in the UK before they move in here to invest.
That does play into a slightly wider one as well, in that energy this year, particularly fossil fuels, has been the kind of laggard. So if you were looking for a contrarian bet for next year, as we've mentioned kind of like a couple of times in the podcast, the energy sector is probably the place to look at this point. Yeah. And if you've got that sense that the attitude is changing towards it, then it's kind of pointing that way quite aggressively as being classic sort of contrarian play.
Listen, I wanted to come back to small caps on the contrarian front because it is the big contrarian play. And Pamela Liberium had a little report out earlier in the week that I looked at, and really depressing reading, looking at US small caps. We're going to end on a positive note, by the way, everybody. We will be finishing this podcast this week on a positive note. So, looking back at the last 100 years, so since 1926, US small cap stocks outperformed large cap stocks by 2.85% a year. So that's marvelous. So you can look at that and you can say in the long run, this stuff massively outperformed. If you look at nearly 3% compounded over even a decade, we're talking real money. But inside those long-term averages, you've got some really, really nasty and very lengthy periods of underperformance. When I say lots, I mean actually two. 1982 to 1999. So a long time, nearly 2 decades,
Wow.
nearly 2 decades of underperforming by 1.6% a year. And then the second bout of underperformance is the one that we are deep in right now, underperformance of 1.7% a year since 2018. So that is not touching the sides of the length of the underperforming period in the 80s and 90s.
Oh man, so wait a minute, what's the good news? Because that sounds like we've got another 10 years.
No, it doesn't have to be so long. The good news is that when it outperforms, boy, it really outperforms. So 1964 to 1981, outperformance by small caps of 8% a year.
8%, actually, that's very good.
Yeah. 1926 to 1941, 4.4%.
Yeah.
I mean, obviously, you can pick your time periods, can't you? But
oh yeah, but it's indicative whenever it's that length of time, and we all, we're all told constantly that small caps, and it's logical that small caps over the very long run should outperform big caps.
And particularly when they're as cheap as they are now, relatively speaking. So, you look at it now and you say this stuff is cheap, this stuff out of favour. It's been absolutely slammed by the shift to passive and absolutely slammed by various regulatory things, particularly in the UK. So it's got to come back. On the other hand, if you'd invested in US small caps over the last 40 years, just the last 40, so not going back to 1926, and averaged out the outperformance and the underperformance, you kind of barely have managed to keep pace with large cap stocks, let alone beat them. So,
Yeah. That's interesting.
The optimistic take is that's where the growth is. That's where the value is. That's where the long-term outperformance is. So maybe next year.
I would think the Magnificent Seven, or sort of varieties of the Magnificent Seven, must make a big difference in the US law, because the whole point about them is they are large caps that grow like small caps.
Yes, until they don't.
Until they don't. Yeah. Well, we'll see about that.
So, I mean, we're saying we'll talk about this a lot in the new year, I think, but you're seeing quite a lot of cracks appearing across the AI story. I mean, just have a look at Oracle. Have a look at Oracle.
And also, just before, what about gold and silver? Why have they had such a wild year, do you think?
Well, I don't know. I mean, they say gold is insurance and silver is a warning, right?
Yeah.
So gold, looking at what's been going on across the last year, everyone has been absolutely fine with staying in equities and seeing bull markets across the board, but also everyone's a bit well, maybe I'll just insure that. And that's gold, and it is a debasement trade, and in particular, it's this new regular price insensitive buyer in the form of the world's central banks. So all that's in there for gold. Silver, to be honest, silver's more your area. I mean, obviously, it tends to catch up with gold, and then it tends to have little manias. So maybe this is a little silver mania.
Yeah, I think that makes sense. It feels a bit like the way the gold miners suddenly woke up and realised that gold was at twice the price the last time they had a decent run.
And so it makes sense, if you've made some money out of gold, it makes sense to turn to silver. And there we go. I mean, I'm definitely keeping my gold. I don't think, looking at the geopolitical environment, that now is the right time to not have your gold. But I'm not sure I'd be rushing out to buy a pile of silver right now. That's more of a speculation than an insurance for me. Yeah,
and actually, this is a long-time reader actually emailed me after I wrote about silver recently and said that he'd just taken a pile of the family kind of silver tea sets and heirlooms that they didn't want anymore down to a silver smeltery and got them turned into hard cash. So I thought that is a problem with silver, because there's a lot of scrap silver out there. And if someone who's as relatively well informed as this particular reader was doing that, it does make me think, okay, maybe we're certainly in the later stages of this silver mania. Although actually that reminds me of one other really interesting statistic that I still haven't properly shared anywhere. The fact that an ounce of silver is now worth more than a barrel of oil. That's not happened since 1980. Like 1980 was the last time. Yeah.
And how long after it passed through that milestone did the silver price collapse?
I mean, like a day. I mean, 1980 was very, a spike for silver, which, to be fair, this kind of hasn't been. But yeah, no, so silver being at parity with oil is quite something. I mean, obviously it was at parity with oil when oil went negative in 2020, but that doesn't really count. So I thought that was a very thought-provoking stat. I don't know what thought it provoked, so. But quite a number.
Okay, so for next year, watch the gold price, watch the silver price. Maybe don't bother with the Bitcoin price. Watch energy.
So
watch what happens.
It's already coming in.
Nobody writes hate mail at Christmas. Do they?
Some of the round robins I get are pretty fruity.
You still get round robins?
No, thankfully. I always hated them.
I don't think people do this anymore. No round robins, no hate mail. Everyone just, focus on your own Christmas. Watch gold, watch silver, watch energy. Really interesting. Watch what happens with net zero in the UK. Watch small caps and keep an eye on the growth value intersection. Anything else, John?
No, I think that is a wonderful roundup. And all that remains.
Well, in that case, all that remains. Go on, you say it. All that remains.
Well, very Merry Christmas, listeners.
A happy Christmas. A happy Christmas to all our listeners. And to you, John, by the way. And to you.
And to you.
Thank you. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts. Also be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Summer Sadi, production support and sound design by Moses, and happy Christmas to you too as well. Thank you for all your work this year. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net. There you go. Christmas wishes on the podcast.